slightly in the red for the market. The sensex and the nifty down about 0.2%.
The nifty is now down to levels of 17,700, 150 points gone on the nifty.
Then 100 points cut at the moment, 0.63% down.
Looking a little sideways from the morning, and I think it's lackluster, right? I mean, not very much going on.
Whatever volatility we had was only in the first 1 hour of trade, and thereafter it was, a pretty flat line on the nifty. By the end of it, closing exactly around that 17,750 mark, a cut of close to about 0.5% on the benchmark indices.
Hello and welcome to CNBC TV18. You're watching Markets Today, the show where we track about 6 hours of the day's trading action in 5 headlines. I'm Ekta Batra. Here are the top stories for this evening. Dalal Street closes largely lower as metal stocks weigh on Indian indices. Nifty and Sensex fall over 0.5%, but the broader markets outperform, with the mid-cap index soaring close to 1%. Vodafone Idea shares rally after the government becomes the single largest shareholder in the company with 33% stake. Street believes the move is a near-term positive for Vodafone Idea, but long-term issues remain. Bank of America says the company needs capital infusion of at least $6 to $8 billion to remain competitive. Adani Group swings into damage control as stocks remain under pressure. Promoters to prepay loans worth around 8,000 crore rupees to release some pledged shares of Adani Ports, Green and Transmission. Renowned valuation expert Professor Damodaran pegs the fair value of Adani Enterprises at 945 rupees per share, which implies a potential 40% decline from the current market value. SEBI seeks the latest beneficial ownership details of the foreign portfolio investors onboarded as bank clients from designated depository participants. Sources say FPI depository participants must provide the information by September 30th or risk losing their registration. That's a CNBC TV18 exclusive. M&M Financial jumps over 7% after a strong third-quarter performance that saw assets under management rise 16% and gross NPA ratio at a 15-quarter low. The Street also cheers the appointment of Raul Rebello as Managing Director and Chief Executive Officer designate. Meanwhile, Paytm rallies as the company turns profitable at the EBITDA level for the first time ever, ahead of its forecast. All right, well, those are the top stories that we're tracking this evening. Here's a lineup of what we have in store for you. It's a packed show as always. In Market Opinion, we have Venugopal Garre, who is the MD of Bernstein. And in Big Voices, we have Nirmala Sitharaman, Finance Minister, commenting on Vodafone Idea. All right, well, on to the first story for this evening. The day's market action. Dalal Street ended largely lower as metal stocks remained a major drag. Nifty and Sensex fell over 0.5%, but the broader markets outperformed, with the mid-cap index soaring close to 1%. Prashant Nair is here with a wrap.
It was a bit of a give-back session on the Nifty. The market started weak. It saw occasional bounces through the course of the day, but never really recovered fully. We ended down on the Nifty about 80-90 points, 0.5%. Banks did a little better, as has been the case for the last few sessions. The Nifty Bank was down about 1/3% or so as compared to what the Nifty did. Metals, IT and energy were the three pockets which saw the maximum amount of selling pressure in terms of trades. Let me sort of dive straight into stocks. So the cuts came through from earnings-related disappointments and otherwise as well. Divi's, for example, was one of the top losers on Friday. It lost another 4% today, making it, a heavy two-day loser. JSW Steel, Hindalco, Tata Steel from the metals and mining space were down, and Infosys from the IT space was the top IT Nifty loser as well. Gains coming through in Adani Ports, which surged quite a bit, 10% after Friday's surge as well. There is, of course, the incremental positive news flow there with regards to promoters releasing a substantial portion of the pledge, which will happen in the coming days, as the official release points out. IndusInd was higher, and there was BPCL, which did well as well. In the broader markets, cuts coming through in names like JSPL, MCX, Piramal Enterprises, JK Tyre, GE Shipping. As I said, a mix of earnings and otherwise. And gains, again, M&M Finance and Paytm earnings related, Indus Tower on the back of rub-off from Vodafone Idea, Varun Beverages, Zydus and Aarti Industries, a few others. I think the global markets once again become a little important after the shockingly strong numbers, jobs data out of the US on Friday. And we got a long lineup of Fed speakers, including the Fed chair, who will speak. And I think we will wait to hear if there is any pushback to market pricing after the very strong numbers there. The Nifty is stuck in a range. On the upside, the 20-day moving average comes into play. And on the downside, the 17,353 budget day lows act as a bit of a reference point as well. Back to you.
Okay, all right, Prashant, thanks very much for that. Well, in market opinion then, Venugopal Garay of Bernstein says that the results season in general is not a driver for upgrades this year, adds that the banking sector will be cautious in lending to the private sector.
From a point of view of certain sectors like industrials, even one of the larger companies essentially had a margin miss, for example. So it's all over the place outside of this, no unique trend per se. So all in all, I would probably say this result season in general is not a major driver for upgrades. So I don't really see much of a change, post these numbers. And neither is it giving you any directional trend for turning, incrementally positive. Private sector capex is not really was expected to be great anyways this year. We were thinking it'll probably start looking good in 2024, 25-ish, years, calendar years. But the reality is at this juncture with what we have seen in the last 2 weeks, I think the banking system will be generally a bit careful about lending to private sector, especially, if it is linked to infra. That is a reality. So the heavy lifting has to be done by the government, right? So, I mean, even though private infra expenditure is not that great, but it's still an incremental contributor, right? So overall, I would probably say it's neutralish to negative from an infra point of view relative to expectations when we head into this year.
Okay, well, moving on to the other big story, the union government is now the largest shareholder in Vodafone Idea. The government owns just over 33% of the telecom company after converting adjusted gross revenue dues worth more than 16,000 crores into equity. The Vodafone Idea stock rallied in trade. However, analysts say that while the move is a near-term positive, Vodafone Idea needs billions of dollars to arrest the loss of market share. Reema Tendulkar is here with the details.
Finally, some good news for Vodafone Idea. After over 1 year, the government has given the go-ahead to convert 16,000 crore of AGR dues into equities. Let's start off by telling you what this means for all the players. For Vodafone Idea, this is a big near-term positive, a big sentiment booster. The government now appears to be committed to the cause of Vodafone Idea, the future of Vodafone Idea, and now with an implicit sovereign backing or a guarantee, Vodafone Idea can go to the banks, raise some money or refinance their existing loan. Dues to vendors can be repaid. Vendors like Industars or even ATC. Remember, Vodafone Idea's proposal to issue 1,600 crore of debentures to ATC Telecom was also contingent on the government approval coming through. Remember, no fresh money is being infused into Vodafone Idea. But as BofA says, Bank of America, that it would free up some cash flows for Vodafone Idea. This, coupled with a potential capital injection by promoters, timing of which is unknown, should help Vodafone Idea clear pending dues of tower companies, vendors, and also invest in 5G. Now, for Industars also, this is a very big positive. Now, Industars has been writing down the receivables from Vodafone Idea for the last 3 quarters. In fact, last quarter, Industar posted its maiden loss because of the write-down of the receivables. But now with the Vodafone Idea perhaps being able to repay Industars, the receivable risk comes down, which is why Industars is rallying in trade. For Bharti Airtel and Jio, this is a near-term negative, because as BofA says, the current government move drastically reduces any risk of Vodafone Idea going into NCLT, and the pace of incremental subscriber gains from Vodafone Idea could also reduce. And in case anyone was pricing in a duopoly for Bharti and Jio, that is unlikely right now. That said, the road ahead for Vodafone Idea isn't going to be very easy. BofA says, according to their channel checks and discussions with vendors, tower companies, Vodafone Idea is significantly underinvested in fiber, 5G and core telecom infrastructure. And it would take Vodafone Idea at least $6 to $8 billion of investment to narrow the gap with peers. This means the company will need to raise external funding to kickstart 5G. External funding could be from investors. It would also mean promoters may need to pump in some money. Remember, peers are already racing ahead with their 5G rollout, but Vodafone Idea is yet to get started when it comes to 5G. And finally, the elephant in the room when it comes to telecom companies are the telecom tariffs. Telecom tariffs will be needed for a long-term sustainable pickup in Vodafone Idea's cash flows.
Okay, all right, Reema. Thanks very much for that. Staying with this story, let's also listen in to what the finance minister had to say on the government's move.
उनका डेट को हम नहीं ले रहे, वो जो सरकार को देना है,
ड्यूज की बात कर रहा हूँ।
हाँ, वो सरकार को जो देना है वो सुप्रीम कोर्ट में चलते, वो सब होने के बाद और कैबिनेट के अप्रूवल लेने के बाद आप कंपनी हमें जो हमारी ड्यू है वो दे नहीं पा रही हो इस कगार में, इसीलिए हम कंपनी का शेयर ले रहे हैं, मतलब कंपनी में हिस्सेदार हो गए हैं, जिससे व्हेन कंपनी कमाई बढ़ेगी हमारे अपने भी मिलेगा।
Okay, well, moving on to the third headline today, Adani Group swung into damage control as the stocks remained under pressure. Promoters will prepay loans worth around 8,000 crores to release some pledged shares of Adani Ports, Green and Transmission. Vivek Iyer is here with more on this story.
Well, that's absolutely right. So, in a press release that came in from the company, some very important details coming in, stating that the Adani Group promoters have actually posted almost $1.1 billion in order to reduce the percentage of pledged holdings in 3 of their group companies, and this is going to be ahead of the expected maturity, that is September 2024. So now, 3 group companies will see the percentage of pledged shareholding by the promoters come down. And when you're talking about Adani Transmission, the promoters are looking to reduce the pledge by close to 1.4%, in Adani Green almost by 3%, and very interestingly in Adani Ports by 12%. Now what is more interesting is the fact that, especially if you're talking about Adani Ports, where they're looking to reduce their proportion of pledged shareholding by 12%, the total percentage of promoter holding pledged at the end of the December quarter was only close to around 17.3%. So a significant chunk of the pledged shareholding is being reduced. When it comes to Adani Green Energy, 3% out of the 4.36%, and when it comes to Adani Transmission, 1.4% of the total 6.6% pledge will be reduced.
What I see in this business is a company that invests in infrastructure investments, which have long gestation periods, require huge capital expenditures upfront, and are not that profitable. It's the nature of the business. So when I approached the valuation of Adani Enterprises, that's what I brought to the game. I had to bring in the fact that this is not a business that can generate 30% margins or 40% margins. You're going to be lucky to get to 6 or 7% margins. The global average for infrastructure companies is about 4.8 to 5%. So at 7%, I'm already pushing the limit on what those margins will be.
Okay, so the news continues on the Adani Group of stocks. We need to take a break now, but stay tuned. We'll be back in a jiffy with all of the other top stories. Welcome back. You're still with us on Markets Today. Let's get to the rest of the stories that we're tracking for you. The fourth headline today, market regulator SEBI has sought updated details of foreign portfolio investors from bank units for greater clarity on registration and beneficial ownership. Prashant is standing by with the details. Prashant.
Well, thanks very much for that. Now, what we understand from industry sources is that SEBI has written an email to banks who deal with FPI registration as a process. This email was sent out last Friday evening with a focus basically on 2 issues. One is FPI registration and the second is beneficial ownership. Let me explain this a bit. So what is SEBI saying? SEBI is asking what are called designated depository participants to reach out to their foreign portfolio investors by the 31st of March 2023. Designated depository participants, DDPs, by the way, are units within banks who deal with the specific function of FPI registration. So SEBI is asking these entities, DDPs, to in turn ask their FPIs who are registered with them to give them the updated beneficial owner details by the 30th of September this year. So there are very clear timelines here from the regulator. The SEBI communication says that if this is not done by the 30th of September, these FPIs would then become ineligible to continue their registration, which would then, according to the email, mean that they will have to sell their holdings, liquidate their holdings by the 31st of March 2024. I mean, I would like to add here that we've written to SEBI for an official comment and we are awaiting a response from them. Now, to explain this issue with some examples, right? As I said, SEBI is focusing on 2 things. Number 1 is registration of FPIs. If I can sort of use an example, if there is, for example, a German bank which is a unit based out of Hong Kong or Singapore or anywhere else which invests as an FPI in Indian markets, SEBI is saying that the legal entity in this particular example, in this particular case, is the German bank, right? And not the unit operating out of Hong Kong or Singapore. Number two, the second issue the SEBI's communication touches upon is identification of beneficial ownership. So if there is a FPI investing in India and there is no entity which can be clearly identified as the owner, the threshold for to be considered an owner is having 10% or more invested in a fund, or control. If these two criteria are not met and a natural kind of owner or controller cannot be identified, then the beneficial owner has to be identified as a very senior person and not a junior person or someone managing money, etc. It has to be at a managing partner kind of level. All in all, clear communication from SEBI that it wants to know the end beneficial owner of FPIs, and there are clear timelines given by which it wants this information as well. As I said, we've written to SEBI and are awaiting a response from them. Back to you.
Okay, all right, Prashant. Thanks very much for that important story there. But let's move on to the fifth story today. Paytm rallies close to 6% in trade as the company turns profitable at the EBITDA level for the first time ever, ahead of its forecast. Abhishek is here with the details.
For Paytm, the contribution margin increased to 50.8% versus a little more than 44% in the previous quarter. So what this helped is that it helped the company report a first-time EBITDA being positive at about 30 odd crores. So they reported EBITDA of about 31 crores, which compares to EBITDA loss of 393 crores on a YOY basis and about 166 crore loss on EBITDA front on a sequential basis. The total income was up more than 39.5% YOY and about 6.3% sequentially. Their net loss has actually declined to 392 crores, which compares to an estimate that ICICI Sec had of about 500 crores, and this also compares to more than 775 crore of net loss in the same quarter last year and about 572 crore of net loss that they reported in the previous quarter. Back to you.
Okay, all right, Abhishek, thanks very much for that. Well, it was a strong quarter for M&M Financial as well, with the assets under management rising 16% and the gross NPA ratio at a 15-quarter low. The stock zoomed 7% on the news. Here's what the management had to say on its assets under management.
We are seeing quarter-on-quarter growth in AUM clearly, and that's at the back of very, very healthy disbursement that's happening, and I think it will continue to move this direction. And we are currently growing at about 20-odd%, and I think we would kind of keep this direction. In next 2 or 3 quarters, maybe post-festival, you would start seeing the interest rates come down. So we don't see any pressure on the NIMs to the extent that we need to cover, we already done. So I think fairly around this NIMs, maybe a 20 basis point here or there could happen. And that could happen maybe also because of the product mix change and not necessarily because of the borrowing cost pressure.
Okay, so that's M&M Finance. But moving on, beverage bottler Varun Beverages surged over 6% or 5% in trade as the company reported what was a strong performance in what is a seasonally weak quarter. Manglam is here with the details.
It's a seasonally weak quarter for a company that makes cold drinks because of winter, but it is this delayed winter, festive season and a low base because it was also the first festive season after 2 years of COVID-related impact that boosted their performance. A strong quarter coming in, 28% jump in their overall revenues, closer to 2,200 odd crores on the top line. The gross margins improved as well, and as a result of which we saw a big improvement in their EBITDA too. And that was primarily because of operating leverage coming in. The margins for the company, 13.9% versus 12%, and the net profit jumped by around 150 odd percent on a low base. Again, the net profit was led not only by the revenue and the EBITDA, but a couple of other factors like lower effective tax rate and higher other income boosted the net profit as well. The overall volume growth of the company this time around was 18%, but at the same time, 70% of their revenues coming from carbonated beverages. That saw a 25% volume growth. That was extremely strong. Juices grew by about 17%, whereas water grew by just around 5-odd%. Sting, which is the energy drink, which does well for them in terms of realizations and margins, is now about 10% of sales, and most on the street are betting for higher contribution coming in from this to improve their performance going further. And as a result of which, their net realization increased by 6% as well. That's just the beverage part of the business. They do have a big trigger coming in from the snacks part as well. So let's see how that plays out. But for now, in a seasonally weak quarter, Varun Beverages actually reported a very strong set.
Thanks, Manglam, for that. But now let's put the focus on Divi's Lab. The stock has slipped over 15% in trade on Friday after posting a disappointing set of Q3 earnings. It was down around 12% on Friday's trading session and has seen an incremental loss today. Divi's Lab's margins were the key disappointment in Q3. The company, which was once lauded for its margins sustaining at over 40%, reported margins at a historical low of 23.9%, led by factors such as cost inflation and pricing pressure. This quarter also saw the impact of COVID-19 opportunities such as molnupiravir depleting. Estimates are Divi's only made as low as $5 million of sales from molnupiravir versus $130 million a year ago and $40 million just last quarter. And besides COVID-19 opportunities depleting, the company was also impacted by the underlying profitability in the generic API business, impacted due to price pressure in the US markets. Some products faced anywhere between 5 to 10% price erosion. Brokerages were clearly disappointed with this quarter, with target prices reduced and EPS estimates cut anywhere from over 10% for FY23 to over 15% going into FY25. The street fears earnings to be impacted more than earlier due to a high base in the custom synthesis segment, price pressure in the US and an overall reset in margin expectations. Lastly, what could help turn the stock around? A few triggers include the Kakinada capex for the company coming on stream, for which the company got a green signal to resume construction, recovery in margins, price pressure in the US settling, and opportunities coming through in other segments such as contrast media and fast-track projects. And valuations, once the darling of investors, the stock has already lost over 40% from its 52-week high and is now trading at over 35 times FY24 PE, which is a far cry from the peak of over 70 times, but still expensive, according to some. Well, on that note, it's a wrap on this edition of Markets Today. Thank you very much for watching.